June 2021, and appreciate you joining us on this beautiful sunny day on the East Coast. Post Memorial Day, before Labor Day, as people are opening up, getting ready for the summer, opening up without masks. The economy is reopening. We wanted to take the opportunity to have a town hall meeting for 2021 to talk about the path forward and some of our perspectives and wisdom that might be of value to our clients, your friends, family, and the community that we've been fortunate to serve. So, welcome. Requisite disclosure, of course, none of the information is intended to be specific advice. Everyone has a unique circumstance and situation. Past performance is no guarantee of the future, so on and so forth. I won't bore you with reading all the details. So 2021 marks over a quarter of a century of my being involved in the financial advisory and wealth management space. And I remember in my very first several days getting attracted to this profession. The idea was to build lifetime relationships with a knowledgeable and trusted advisor. And that really struck with me because every interaction that I've had from day one to now that we've indoctrinated into our culture is to nurture these lifetime relationships beyond myself to a knowledgeable and trusted advisory team. So I feel grateful of the team that we have now, which includes CFAs, people that help with taxes and insurance, and JDs helping with estate planning and operations and trading and compliance, and a lot of tremendous resources that we have at our clients' disposal. And it's been a blessing that we've had 98% retention over 25 plus years, and all of our relationships have come through advocacy of the relationships that we have. So we're grateful for your being our sales force to spread the word that we're doing good work for you and your families, and that other people may benefit. So thank you. And in order to develop lifetime relationships, our team has actually come up with quite a nice acronym, FAMILY. And in thinking about what a family means, some people have a blood family and some people have a chosen family, and or some combination therein. So we have a SAM family that we're fortunate to have you all be part of. And the SAM family, the acronym includes F for finding a way, which means that we're going above and beyond every time for our clients and one another each and every day. A for attention to details, which is operating with an exceptional level of care. In fact, I just read an article about Steve Jobs' father would be meticulous about a wooden fence, and the back of the wooden fence, a part of the wooden fence that no one would ever see, and the detail, the aesthetic of that fence needed to be perfect. Even though no one would see it, he would know. So the attention to detail resonates if you want to feel pride in the work that you're doing. M for meaningful relationships, which is treating our clients with the utmost integrity, and the relationships with our coworkers and our vendors and everyone that we're fortunate to have working relationships with. Clients, accountants, attorneys, and the like. Innovation. I for innovation includes continually finding smarter ways to do things. Innovation could mean a lot of things to a lot of different people, but in the realm of impossible, there's always possible. So we're using innovation to find a way to move things forward and solve problems. So long-term focus is trying to help people think about those lifetime relationships and fostering a peace of mind and long-term abundance of a mindset that gets out of the day-to-day and helps people think multi-generationally in a sustainable fashion to be able to get to your why. Why are we here? What are we doing? What are each person's unique abilities, so that we can unlock potential of one another and unlock the potential of our clients to be able to do some amazing things in the world. And we've been fortunate to have some people lead some incredible lives and do some amazing things. And just being a contributor or a fly on the wall to be able to make some contribution in the mindset of the people that we're able to influence has been extraordinarily meaningful. So we ask tough questions at times in order to enhance decision making and really challenge people to think through, how do we build a family and how do we build a life that everyone feels is as rich as possible. Richness being beyond the dollars and cents involves several P's. The staying on a path. I scribed a book about the idea of a rich life, and it was more than about money. It's about helping people get onto a path and applying a philosophy and a process that keeps people from falling off the mountain. So my team came up with a great picture here that reminds us of the idea that if you find the groove, you can make it up the mountain. But if you're yes, there are some people that can maybe make it off of a flat face, but by and large, we'd rather get you onto a safer path that is going to increase the probability of your success. So one of the key lessons, and this is, I know, off topic perhaps a little bit, but something that is top of mind for me has been the cultural tension of the moment. And of course, there might have been cultural tension for the last 50 years, but the cultural tension today feels extraordinarily intense. And I believe that as people start opening up and going outside and traveling and interacting, and they take off their masks and everyone has a different sensitivity to how people show up in the world, there's tension politically, there's tension religiously, culturally, gender, religion, internationally. We're not going to be able to solve all the problems today, nor do we promise to solve all the problems. But what we can do is focus on our people and the culture that we're building to be able to have a little bit more of a purpose around impacting the people in our ecosystem that we can impact, starting with ourselves. And if we can do that, then we can have our small little dent in the planet in our little way. It may not be grandiose, but in our small way, we can make contributions. So I have been really thinking through this slide. I know it's not on the topic of finance, but I believe it is going to help every single person. It certainly has helped me to show up for people in a better way. We'll start with the idea of awareness. When you interact with people, there's a degree of mindfulness that is required to be able to pause, deeply listen, deeply hear someone, and really try to understand the other person's perspective. Because I know for myself, if someone says something that I completely oppose, that I think is black or white, or if there's some shade of gray, there's no black or white, there's shades of gray. But if I vehemently oppose someone's ideology of how they're conveying or how they're showing up in the world, my first level thinking is to react and get triggered into fight or flight. And that's not healthy for me or for them. So it's helped me to pause, breathe, really deeply listen without reacting, and then reflect on the situation of what someone's saying and have enough emotional intelligence to realize that their opinion matters, whether it's valid or whether it's invalid from my upbringing, my root, my background or my belief system. Their perspective matters because no one's walked through someone else's shoes. So you have to be mindful that there's a different set of lenses, different set of glasses that people are going to see the world. For me, my only option to be able to connect with people is to have fierce optimism. And that fierce optimism for me translates in the idea of finding a common thread. Finding a common thread to really hear and understand someone. There could be 613 things we disagree on, but find the one common thread that we do agree on and try to build on that thread, because that can lead to some behavioral change for me, for the person that I'm with, whether it's a coworker, whether it's a vendor, whether it's a client. And then ultimately, it helps us learn together how to show up for each other's collective well-being, to be able to look out for each other's best interest. And I think that if each one, at least if I show up that way and my team shows up that way, and we can influence some other people to show up that way, then we can have our small little impact on impacting the world beyond ourselves. That fierce optimism translates into the Dow Jones Industrial Average, now turning to finance. Having started 125 years ago, as you see the quick 30-second 125-year progression of the Dow Jones, which represents the 30 industrial companies that are supposed to be a reflection of our economy. And you can see there's been 20 plus recessions during this period, setbacks. And in spite of that, on all those setbacks, you see that from 40.9 being the measuring stick of the Dow Jones Industrial Average, as of May 26, 2021, it's 34,312. So fierce optimism is the only option to be able to look forward in finance, that every setback is an opportunity for a comeback and a bigger and better future. And I say that with unwavering, because as the only benefit to pessimism, as I've said jokingly many times, is you die early and then you got nothing to worry about. So be optimistic and realize that every setback really is an opportunity. And for Sam's evolving process and philosophy, what we have done is relied on research and evidence and try to continue to evolve our process around the evidence. And I have a logical brain that thinks through this, because I want to create peace of mind for the people that we're helping and improve the odds of success over a lifetime. And it's important because I'm not a fan of the casinos or gambling or Las Vegas. You know, of course, Vegas has very big hotels because the house generally wins. Well, in this case, I don't want the house winning. I want the clients to succeed over a lifetime, and I want Sam to succeed over a lifetime, and the team to succeed over a lifetime. So to be able to design a portfolio, we're focused on dimensions of expected returns and factors that really matter, that makes sense. Because I say jokingly, look, ultimately, you know, if we want to sit and fish or sit on a beach, in order to sit on a beach and be able to collect profits from other people's labor, it doesn't matter whether it's a surfboard shop or a pizza stand or whatever it is. You want to invest in a business that is, you own the business, you have stocks over bonds, that the companies are generally smaller versus larger. We're buying it cheap, a little bit cheaper than growth oriented, and we want it to be profitable. But those factors, ultimately, they need to be sensible, number one. They need to be persistent. They need to be pervasive. They need to be robust, and they need to be cost effective. And if we can find ways to invest and continue to evolve our process for those efficiencies, the cost effective is very important, because taxes are going to be becoming a greater share of people's burden in the decades to come. And we really need to think through the decisions we're making, not just short term, but over 10, 25, 30-year timeframes, over not just someone's lifetime, but next generation and the next generation's lifetime. Now, why do we focus on these factors? Why are these factors important? Because, again, going to the odds, we want to stack the evidence and the odds to someone's success. I'm not an expert at blackjack, but you know, certainly if the dealer's showing a 5 and you have 16 and you're sitting at a table and someone hits every time they have a 16, they might win 10 times in a row. But it's not a strategy that I would say is going to increase the probability of someone's success. It's not a strategy that is going to have persistency. You're not going to have the odds in your favor. So if you look at the data and the evidence points to the fact that equities beat bonds over time, value beats growth, small beats large, and profitable beats unprofitable. So why not stack the odds in your favor and play the odds of success? The important reason we do this is because over general market cap weighted indexes, simple market cap weighted indexes, there's premiums or excess return that can be generated of between 2 to 5% a year. 2 to 5% a year compounded over decades is huge, is gargantuan. You know, with the 10-year treasury at, you know, 1.5% and equities providing historically a 5% premium, if we can get an extra 2 to 5% on top of that, it's going to inure to a tremendous benefit to clients for their lives and the next generation's life. The important thing to focus as we go to the next slide is these factors do not work all the time. The reason we need to extend the time frame and spend our time educating you through these webinars and through one-on-one coaching is to recognize that a process and a philosophy that is going to stack odds in your favor means it's going to work over time, not necessarily all the time. And that over time is important to note, because as you see by these visuals, you can see the up bars showing periods of outperformance and the red bars showing periods of underperformance. There are going to be extended periods that some of these things won't work. And trying to combine a scenario where that people can be as bulletproof as possible is very important. The one, well, generally people like to highlight the winners. In this case, I'm going to focus on the loser. You could see the last decade. If I were to highlight for a moment, I'll annotate just as a little kick and gaggle, you'll see that value in the United States has underperformed materially in the last 10 years relative to the vast majority of time in history. Now, let's carry this forward to the next slide of why I'm highlighting the loser is because during the last 100 years, you see that the other material time frames, aside from most recent, that the markets had in value has underperformed so significantly, ended in 1999 and 1939. So this recent period is an outlier, is an anomaly in history. Now, if anyone remembers 2000 to 2009, the market cap weighted indexes returned 0 in the United States. That doesn't mean that portfolios returned 0. Actually, leaning toward value and other factors had generated very solid returns. So this is an important thing to note, that past performance is no guarantee of the future, and there is something called reversion of the mean, that leaning into other people's giving up is sometimes quite beneficial. So the inverse of that is that today's winners aren't necessarily tomorrow's winners. So people want to know, well, what's been hot? What's working now? And of course, what's working now and what's doing great at this moment in time, probabilistically, is not going to do as well in the next 3, 5, 10 years thereafter. So it's important, as we go to the next slide, to follow this strategy, because there's a concept I had stumbled upon that really resonated with me called Veblen's principle. It generally applies to luxury goods, you know, like Hermes. The higher price that you put a handbag, the more someone's going to desire the handbag. But let's apply it to security prices for a moment. I've intentionally taken off the name of the securities, but what you notice is that as the prices rise in a particular security, volume picks up quite materially and people get super excited about it. Now, this is interesting. As you're going out and the economy opens up and your summers open up and you go to barbecues, you go to cocktail parties, you start meeting people, what people are going to do is the concept I've talked about previously, and I've written about in the book that we scribed, is the concept of Blanche's laughing tickets. No one's going to tell you their failures. All they're going to do is at the cocktail party, they want to tell you how smart they are. So they're going to tell you, why don't you own blah, 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 whatever blah, blah, blah is at a moment in time. And of course, it's easy, particularly when people are not following a process, to get sucked into buying the blah, blah, blah at the cocktail party at the moment, because it feels like you want to be in with the crowd. You want to be in the know of what's happening and what's going on. But if anyone's gone to Orlando or Anaheim in Disney, there's something called the Tower of Terror, where they take you up and then they take you down real sharply. So a lot of people don't have a profitable, persistent process because it's easy to get seduced. We're all easily seducible, particularly after a couple drinks at a cocktail party or your barbecues over the summer. So be mindful of this Veblen's principle of not getting seduced into the latest and greatest. I'm showing a couple other charts just to reinforce the concept. You can see that it happens quite frequently. I mean, I could probably do a webinar each and every day and highlight something that people are getting enamored with and piling into. And it's easy to get seduced, but I would suggest that if you're going to get seduced by something that sounds fun and sexy, just do it by a little bit, enough that you're not going to hurt yourself if something goes awry. Now, in this regard, I wanted to highlight something. I talk often about money flows. And you could see a year ago at the pinnacle of the financial shutdown when COVID started, you saw money flows massively, massively negative. Now, it makes sense because people are like worried that they don't have money to pay their bills, or they don't have a job, or just concerned about the future. It's a very common occurrence, but this happens over and over again, like Groundhog Day. And that's why, in my view, in our view, that planning is completely undervalued relative to investing. Everyone wants to know about investments. How are my investments doing? Well, planning is much more important. And our planning process is simple, just trying to keep an inventory like a doctor of your balance sheet and cash flow. People don't take an inventory of their balance sheet and cash flow. I mean, I don't know that everyone goes to the doctor every year and takes an inventory of their blood work either, but it's extraordinarily helpful to preventative in anticipation of situations that may come about in your life. And from a planning perspective, if you have a stronger balance sheet and we've taken into account adverse circumstances with cash flow and the like, you can avoid being a forced seller at an opportune point in time, and you could be a lot calmer in your process of investing. And as the market goes crazy in one way or direction, you can maintain your calm demeanor, and it's going to help you see things from a much clearer perspective. So I still believe that it's not difficult to find good investments. The hardest part is enabling people to capture the investment return they deserve over a lifetime. And our goal is to minimize this gap. This gap has noted to be anywhere between 2 to 6% a year lost by investors purely due to their own behavior. So when people say, oh, I don't like to invest in the stock market, or I don't like to do whatever, they've had bad experience, it's because they don't have a persistent process. So we're trying to avoid the same old sad story. And we've been blessed to be able to influence and impact the clients that we have. And I'm fortunate and grateful for all of you for being advocates for our services, to be able to continue to contribute to other people's lives and to make an impact. So if we can educate you about our process and how it evolves, and educate you about new things that are happening in the world and how it may impact you, we've continued to add team members and talent and people to bring wisdom, help next generation and other perspectives to light when you need support, structure and support for whatever's next in your world. And with that, I'm going to pass it to my colleague, Jason Blumstein, hailing out of St. Thomas Aquinas and Lehigh, former left tackle, coming in at a strong 6'2", 240 pounds. He's got our blind spot, and he's going to educate us on some other market trends and activities in order to keep us on our path from falling off the mountain.
All right. Thank you, Jonathan. Appreciate that. So I'm going to talk about what things look like looking forward. And essentially, there's three main topics that are on top of people's minds that we constantly get from clients, that you read in the newspaper, that you hear throughout the media. And while we do not like to get people focused on the short term, we definitely think it's prudent to address these topics to get how we think about things and how we're handling them in clients' lives. So the first is market activity, inflation trends, and cryptocurrency. So as Jonathan said, I grew up in South Florida, huge sports fan, played football in high school and college. And I was always enamored with this concept of swag or swagger. Growing up in South Florida during the 80s and the 90s, the Miami Hurricanes won 5 national championships. And they had this saying that the U invented swagger. And what you can see here is one of my idols growing up in Warren Sapp, who was a dominant defensive tackle in the day and was probably the epitome of swag. Swag is this humble self-confidence that you're going to win. You're going to show up to the game, you're going to win, you're going to show up to any situation, and you're going to win. At SAM, we like to describe swag and have people have the same swag mindset, but we define it as having sustainable wealth for all generations. And what this means is when people start to ask the questions, well, markets are all-time high, should I invest now? And we touched upon this in our last quarterly commentary, is to have this swag mindset. And the swag mindset has people think about decades rather than days, facts over fear, and I really have a multi-generational approach because most people aren't just investing for themselves. They're investing for their kids, their grandkids, and really have that multi-generational endowment mindset. So with that concept of having facts over fear, what we're displaying here is essentially looking at how many monthly all-time highs there have been in the S&P 500 going back to 1926. And if you actually look at it over time, monthly market highs are a lot more commonplace than one might think. There's actually been 340 total monthly all-time highs happening very frequently in every single decade. Now, if you break that down even further, that means that 30% of the time, or every 3 to 4 months, you're going to see another market all-time high. So again, providing those facts over people listening to the media, their friend, their neighbor, saying, oh, markets are all-time highs, it's foolish to invest now, I missed the boat. Well, even further pressing on that concept of, oh, you missed the boat, it's silly to invest now when markets are at all-time highs. Well, if you would have invested at any market high, previous market high, and waited 1 year, there's been an 81% chance that after a year, you would have had an additional market high. If you thought a little bit longer term, 5 years, which in our view is still fairly short term, you would have increased your odds to having an 85% chance that you would have had new market highs after 5 years with an average return of 9.9% per year. And this really shows the power of compounding because 9.9% per year over 5 years is a 61% total return. The next concept that is pervasive throughout our country and in the media and questions from clients is, are we going to get inflation? So we wanted to show this in context. And this is a concern mainly because the US has seen fairly tame inflation of 2 to 3% over the past 25 years. And really the only time where we've seen inflation was in the 70s and early 80s. And right now there's a lot of concern because the last reading on CPI was above 4%, which is above our norm of 2.2 to 3%. But this needs to be taken in context because if you think about what took place from March to June of last year, we actually had some slight deflation as our economy shut down. So when you are coming off a low base, these are year over year figures. So the numbers are a little bit distorted as our economy reopens. Now, everyone, when they talk about inflation, the big thing that everyone talks about right now is, wow, we've seen a tremendous amount of money supply come into the system over the past year. And what you can see on that green line, the lime green line, is that money supply last year increased by over 25%. The last time this happened was during the Great Depression. And everyone thinks, oh, well, money supply increased so much, of course we're going to see inflation. Well, this is not necessarily true because if you delve deeper into, say, an economics 130 or 140 course, you've understood the concept of the velocity of money, where it doesn't necessarily matter about how much money is in the system, which the Fed can easily add or take away. It matters how quickly money is moving around the system. How quickly am I going to shop, and then that person at the shop is buying another good, and then Christine's buying something at the same shop, and money's really moving around the system quickly. And that's when you start to see inflation. And it's really only when you start to see what we show over to the left on the chart, where in 1975, where you saw the red line, which is the velocity of money, and the green line, which is the supply of money, when money movement started to pick up, the supply of money went down, and lo and behold, in 1975, you started to see inflation. again, we got inflation a little bit under control. And then you saw the same thing happen in the early 80s, where again, you see the red line, money supply starts to pick up, velocity of money starts to pick up, supply comes down, inflation goes up. And so bringing it back to the right side of the chart, what you can see is, yes, money supply did pick up dramatically last year, but look at the red line. The red line is the velocity of money, which plummeted materially as well. So this is something that is really needs to be looked at a little more seriously. Now, there's also two types of inflation, both of which we're experiencing right now. The two types are demand pull and cost push. So demand pull is essentially demand for goods has increased, so prices go up. The best example of this, in my opinion, is the iPhone. The iPhone, if everyone recalls, when the iPhone came out, companies were giving it away for free. AT&T, Verizon, they were giving away the iPhone for free because no one was sure what the market demand for the product was. Well, as 10 plus years later, as we know what the demand for the iPhone is, now you can't buy a brand new iPhone for less than $1,000. So again, as demand goes up for a product, the company pushes up the price, and because demand has increased. The next concept of inflation, the other type of inflation, is cost push, which essentially happens when there's supply disruptions, whether that be labor, capital, or materials. And when there's disruptions in labor, capital, or materials, input costs increase, and companies push those input costs onto the consumer, which raises prices. So for demand pull inflation, what you can see on this chart, this is personal consumption in America. And what you can see is that during 2020, demand plummeted. From January 2020 to June, you can see that demand fell off a cliff. And from there, as the economy has started to reopen up, and people have come to grips of COVID, and a lot of more people are going out and about, you've seen demand has increased, but what you also see is that demand has not gotten back to previous highs that we saw before COVID. So yes, do we expect some demand pull inflation? Yes, but this is mainly short term to make up for the lost consumption during COVID-19. And another example of cost push inflation that's going on right now is in the semiconductor industry, where what people have to understand is that we live in a global economy. The supply chain is global in nature. The US didn't shut down, just shut down. China shut down, Europe shut down, Japan shut down, the Middle East shut down. Every single economy shut down. And as every economy starts to reopen, and given our supply chain is now global in nature, which does have some benefits, the short-term cost of that is that there's going to be some short-term supply disruptions, which has hurt the semiconductor industry, and you start to see chip prices go up, whether it be affecting production of phones or cars, but this is going on throughout many different industries. But mainly, we think this is transitory in nature. So maybe you think to yourself, well, it doesn't matter necessarily what you guys think. What does the market as a whole think? And the best way to see what the market as a whole thinks is to look at this concept of the spread between a treasury bond and its corresponding treasury inflation protected security, or TIPS. So what's the yield on the treasury bond versus the yield on the TIPS? And if you look at the spread between those two, you'll see what the market as a whole is forecasting what inflation will be. And this is a global market. The United States Treasury, the 10-year Treasury, is not just owned by US citizens, it's owned by countries and people across the globe. And it's a very liquid market, and it's very informationally efficient. So what you can see here is that the 10-year TIP spread is saying that the market as a whole thinks that inflation will be about 2.4% over the long term, which is in line with historic norms. Okay, so let's just say we're wrong and the entire globe is wrong with what's being priced in the TIPS market. So what do you do to protect against inflation? Well, what we've shown here is the annual returns and the annualized returns of the entire period of the last time we saw inflation in our country, which is, as I said earlier, in the 70s and early 80s. And what you can see here from the assets and asset classes that we own for clients, the place to be was to own equities, whether it be the S&P 500, which returned 7.7% per year. Small caps, as we want to lean on smaller companies, have returned 14.3% a year. Berkshire Hathaway, which we own for clients, returned 24.4% per year. REITs returned 9.3% per year. Now, the one thing that's different between then and now is that if you look at the yellow bar, is that the U.S. Treasury bond, the 10-year bond at the time, averaged a 9.1% yield. Now that's vastly different than it is today, where the 10-year Treasury is yielding anywhere between right now about 1.5 to 1.6%. And if inflation is 2 to 3, you're actually getting a negative real return on owning Treasury bonds. So the best way to think about it is that if you want to protect yourself against inflation, is to continue to own businesses. Businesses, another word for businesses, the way that we talk about it here, is equities, right? Because at the end of the day, one person's inflation is another person's revenue. Now, the final topic I'm going to talk about is cryptocurrencies, which are currently all the rage and pervasive through whoever you talk to, whether it be my brother, my next door neighbor, whomever you talk to, they're all talking about cryptocurrencies. It's all over the media, newspapers. My mom even sent me a link the other day about some cryptocurrency. So everyone's talking about it. So we felt that it was prudent to address it. So what we've displayed here on the left is essentially the way the system for cryptocurrencies and specifically Bitcoin works. I'm not going to attempt to walk everybody through this, walk everyone through what this means, because it took someone on our team 45 minutes to explain this chart to me. And the biggest thing to take away from this is that there's many different players. It's convoluted, it's opaque, and there's a lot of moving parts. And when you look to invest people's money, your own money, there's a concept of staying within your circle of confidence. And if you stay within your circle of confidence, it's okay to say no. No one will ever get upset if you say no. If you say yes and you're not 100% certain about it and something goes wrong, that's where you get into trouble. So given the opaque nature of Bitcoin and cryptocurrencies, we would advise to take a breather from it, given the opaque nature of the asset. Now, there's other tangible reasons why we would have concerns to consider about Bitcoin and really all cryptocurrencies. Is four main reasons. Number one, the asset kicks off no cash flow. So if you're looking to buy a business or buy a piece of real estate, you value that based on the cash flows that the entity is kicking off to you. Because at the end of the day, if you buy it for a certain price, there's a quantifiable value you can put to say, okay, I bought it at a certain price. I know within X amount of years, I'm going to get a return of my money And then after that, I'm going to get a return on my money. With cryptocurrencies, there is no cash flow. So it's more based on emotions. And we've seen this throughout history, whether it be tulip bulbs or even Beanie Babies. These things that are based on people's emotions, you've just seen a history of things going up and then coming down based on people's emotions. The second thing is that the irony of cryptocurrencies is that they're not sustainable whatsoever. They take a lot of energy to mine the cryptocurrencies. If you computed it on just the US consumption, it takes up about 2% of the US's energy consumption. And to gain a little bit more perspective on that, if you look at a smaller country like the UK, it consumes about 31% of the electricity generated in the UK. There's also slow transactional adoption, where people aren't really using it as a currency. They're really using it as a speculative investment tool. So no one's really using it as a currency. If anything, you've seen the US have some chatter about cryptocurrency and its use in the US. And you've actually seen recently China actually act on it. And let's just say you thought it was a good investment idea. The last part is there's limited investment structures, the way to even invest in it. The main vehicle to use to invest in it is actually being priced at 40% higher than the underlying value or what people are pricing Bitcoin in the marketplace. So there's no really good investment structure for Bitcoin or cryptocurrencies at this time. And with that said, I'm going to kick it off to my colleague, Christine Lucero, who heads up our private wealth group at the firm, who, in my opinion, is the best estate planner that I've seen. So with that said, I'll pass it over to you, Christine.
Thank you, Jason. Hi, everyone. Today, I'm going to give you an update on proposed changes to income and estate tax laws. So Joe Biden announced his American Families Plan on April 28th of this year to build a stronger economy that doesn't leave anyone behind. And the plan is to be substantially funded by tax increases, no surprise there, primarily on wealthy taxpayers. This plan is separate from the Made in America tax plan, which deals with corporate taxes, and we're not going to be discussing that today. Further clarification was made in Biden's Green Book issued on May 28th. This comes from the US Treasury, and we'll be going over the details of this over the next few slides, but just be mindful that considerable changes can still happen in the weeks and months ahead. So under Biden's Green Book proposal, he purports to raise the top individual federal income tax rate from 37% to 39.6%. The top rate would apply to income for individuals at about $453,000 and for married filers at about $509,000. The proposal also taxes long-term capital gains and qualified dividends at ordinary income tax rates for households with AGI over $1 million. So the actual tax rate could be as high as 43.4% once you take into account the Medicare surcharge. And this is almost double the current rate, which is at 23.4%. So a really big change there, and not a welcome change. The proposal eliminates deferral of tax on like-kind exchanges of real estate, known as 1031 exchanges, when the gain is greater than $500,000. So for real estate investors who have been able to shield the tax on these transactions, starting in 2022, if this passes, they won't be able to do that anymore. The proposal is silent on the $10,000 cap for state and local tax deductions, what we call the SALT deductions, which were put in place by the Trump administration. And it's also silent, surprisingly, on increases to estate tax rates and decreases to estate and gift tax exemption amounts. The proposal triggers a tax on appreciated property transferred by gift or at death. The assets transferred are treated as a realization event, basically as if they've been sold. It applies to gain above $1 million per person. There are exceptions for property passing to a spouse or charity, for certain tangible personal property, not including collectibles, and for family-owned businesses and small business stock. The existing capital gain exclusion of $250 per person, $500 for married filers, it would apply. So you're looking at a top exemption amount of $2.5 million for married filers. Note that most of these changes will be taken effect after December 31st, 2021, except for the increase in capital gains and dividends rates, which right now would be retroactive to April 28th of this year. There are other tax proposals that are currently in the Senate for review. One of them is the STEP Act by Senator Van Hollen that deals primarily with income tax reform, and for the 99.5% Act by Senator Sanders and White House, which deals on the estate tax side. So looking at the STEP Act first, this is in line in some regards to Biden's proposal. Taxes will be owed on unrealized capital gain on transfers of appreciated property, either by gift or at death. There are exceptions for transfers to spouses and charities. There is $1 million exemption, just like under Biden's plan for estates. However, there is a departure from Biden's proposal in two really important ways. One is that there's only a $100,000 exemption for lifetime gifts. And the second is that there's a retroactive effective date to basically January 1st, 2021. So this year, so any gifts or transfers made in this year would be subject to the capital gains tax if this were to pass. For the 99.5% Act, this deals again on the estate and gift side, and all changes are effective January 1st, 2022. For estate tax exemption and rates, it looks to decrease the exemption to $3.5 million per person. This is a significant change from the current $11.7 million that each person has under the law. It also looks to increase the rates from the current flat 40% to a gradated rate, 45% for estates between 3.5 and 10 million, with a top rate of 65% for estates of $1 billion or more. On the lifetime gift side, it looks to reduce the exemption for lifetime transfers to $1 million. This is huge because that is currently tied to the state tax exemption. So we all have the ability to gift $11.7 million today. And if this goes through, that's going to go down to $1 million. It also limits annual exclusion gifts, currently $15,000 per person, to a max of 2 times the annual limit, which would be $30,000 this year, on gifts to some irrevocable trusts, like ILETs specifically, which could have an impact on some of our current client estate plans. So what is the bottom line here? Nothing has passed yet, only proposals at this point. Any of the current proposals could come into play at some level. There's also a lot that I didn't discuss. I tried to keep it to the most relevant parts for our client base, but there's certainly a lot more in these proposals. There's a lot of uncertainty, including retroactive dates under some of these proposals. So there really isn't a best planning scenario. However, estate and gift exemptions remain at an all-time high. So that does prevent a real opportunity to do something on the gift and estate planning side. So the key takeaways for today would be that planning is personal to each client, that these are bold proposals that may not go into effect exactly as we see them today. And also we're here as always to discuss any planning strategies, whether on the income or estate tax side with you, and to coordinate with your accountant, attorney, and other advisors as needed. So we did get some really great questions, which we'll go over. So the first one deals with planning, so I'll tackle that. What are some financial planning strategies for retirees as it relates to long-term healthcare and assisted living? And the second part, how do we best protect our investments when the high cost of healthcare is imminent? So again, great question. As far as some of the financial planning strategies as it relates to long-term healthcare and assisted living, so you can self-insure or you can buy long-term care insurance, which will cover assisted living, nursing home care, as well as home health care, or some combination of the two. So most of the long-term care policies that we're putting in place for clients, they're not designed to cover every expense that is anticipated should you need long-term care. They're designed to help offset the costs. So you're not draining your savings completely. You have help in the form of a long-term care policy. So I'm happy to discuss long-term care options with any of our clients that would like to reach out to me. As far as on the protection side, so there's really three ways that you can protect your investments. One is make sure that you're aligning your investments, the portfolio, to the actual need. So if there's an anticipated need for high healthcare costs, you may have to have more equities, but basically it's going to give you flexibility to cover that higher cost of healthcare and also be able to pass assets on to the next generation or your heirs. The second piece is life insurance. You could basically spend every dime that you have on high healthcare costs, long-term care costs, and you know that there's a life insurance policy, I would probably recommend a permanent policy, that would pay out if you were to spend down all your assets. And then the last option on the protection side is really where you get into removing assets from the estate. So more like gifting either directly to your heirs or gifting to irrevocable trusts and other structures of that nature. They can get pretty complex, but they are effective. So ultimately it comes down to your particular goals and just knowing that you do lose control of assets when they're given into some of these irrevocable structures. So there are some downsides, but again, I'm happy to discuss any of these scenarios with any of our clients that are interested in learning more. So another great question we received. This one I'm going to give to Jason.
Yes, and the question that we received is, given the proposed tax law changes, specifically regarding capital gains taxes, are you managing portfolios any differently? I'll take a step back and just remind everybody, we've talked about it in the past on webinars and with clients, is that over the past couple of years, we really upgraded our back-end technology to really hone in on individual tax lots and have technology that gives us the information of which is the best tax lot to sell for people, given that most of our clients are taxable entities. So regarding capital gains taxes, as Christine noted, none of these laws have passed yet. As we talk with clients, it hasn't necessarily happened in the portfolios that we manage for them, but as you know, we advise everyone on their entire picture. And there's been cases where if you work at a company or you're an executive and you have a lot of concentration in that one company, and and we've talked and we've had a plan to sell those shares over time, given the fact that if capital gains taxes change, they're probably going to go up. So it makes sense to at least step in front of this and sell some of those shares now at the lower capital gains rate. But of course, this is all unique to each individual. And if the laws change, we will update the numbers accordingly as we manage people's portfolios and make sure that we're managing everything in the most tax efficient manner. And of course, if you have any questions on how that affects you individually, do not hesitate to reach out to us. And the final question we received, which Jonathan will answer, is how might B-type corporations and related companies or funds be progressing as a result of the current market climate?
Thank you. So this has been a topic that I've spoken to many clients about over the past decade plus, about being mindful of the kinds of investments we're making and the impact they're having on the world and the climate and the environment. I think ESG has become a booming industry. Couple things to say, and there's sort of two questions within this. First, we'll start with the B-type corporations. For those that aren't familiar, there's a new form of business instead of a traditional corporation called certified B corporations. There's currently 3,979 companies in 74 countries in 150 industries that are B corporations. By comparison, there's 50,000 plus publicly traded companies. So it's still a very small fraction of the companies that have adopted the certified B Corp status. It's kind of a new kind of business that balances purpose and profits. They're legally required to consider, keyword is legally required to consider the impact of their decisions on their workers, customers, suppliers, community, and the environment. So it's a community of leaders that are driving a global movement of people using business as a force for good. So SAM, as we've been structured, is a legal LLC, and we've thought about it. We continue to evaluate the merits of converting to a certified B corporation. It's it's a little. I actually know the founder of the movement, and it's a business like anything else. So you have to fit into the boxes that they slot you into in order to qualify. So it's something we continue to evaluate, but I just think it makes common sense, even though we're not legally obligated as a business. We constantly think about the profits and purpose to which we are going about operating and the impact on clients and vendors and employees and SAM, sustainability in general. I just think it makes good business sense. The legal requirement in some regards is a little funky, but we won't get into that to depth. But the point is, it's a good trend. Now, how does it impact SAM and or the funds we invest in vis-a-vis climate change? This is actually a different answer. There are a lot of different filters for ESG and climate change work. In fact, we're a big user of dimensional funds, which has a fund that actually invests in sustainability, which we have invested for clients who have explicitly asked us to use for this purpose. And what's interesting is that we've done some analysis, and oddly enough, the high profitability factors that we are leaning toward actually have lower CO2 emissions and lower impact on green gas and the environment than the actual sustainability filter. Because generally a lot of the filters are exclusionary. They don't dig that much deeper. So if that's your only filter is what to exclude, well, it's easy. Just exclude guns and tobacco and some kind of obvious things. That being said, of course, we'd like to avoid things that are going to do harm to the world, but we also want to more accentuate the things that are going to benefit our clients. So the trade-off is something that we weigh every day, and we continue to look at it. So if we can find a better way to increase the efficacy of portfolios and minimize climate impact, of course, we're going to continue to consider it. If someone has a specific question about their portfolio and wants to do a deep dive, we're happy to dig deeper, and we can make some further iterations if necessary, if there's something that a specific client has a request upon. But by and large, it's something we're mindful of. And the movement is not perfect. Some great skeptics might say, oh, well, it's just a marketing ploy. And, a friend of mine had a publicly traded company that just went to the public markets as a B corporation. And because of the B corporate status, it shot through the roof on day one. I think it was up, 100% or so. And subsequently now, because at the end of the day, people want to invest in a business for profits, the share price is below the initial offering. So, we don't want to focus on one factor and one factor alone.